Welcome back to the Fund Monitors Meet the Manager series. Montgomery are a well-known firm in the Australian funds management market, and recently the Montgomery Small Companies Fund celebrated its one-year anniversary after being started in September 2019. I think most investors would agree that with the benefit of hindsight, the last 12 months was a pretty tough time to start a new fund. But as they say, volatility breeds opportunity. And the fund has done very well in its first year, returning 15.6% for the 12 months to the end of September, outperforming the Small Ordinaries Index by 19% and the ASX200 Total Return Index by over 25%, as shown on the screen. I'm joined today by Gary Rollo, the Portfolio Manager for the Montgomery Small Companies Fund. Gary, thanks for joining me.
Oh, thanks for having me. Looking forward to our chat.
Gary, the fund has passed its 12-month anniversary and you've come through a pretty volatile period with very strong outperformance. Can you tell us a bit about your investment philosophy and how you've generated such strong numbers?
Okay, look, thanks for that question. Let's go to investment philosophy first. As you mentioned, we target small companies domestically here in Australia. I mean, our view is that innovation in Australia, it lives in small companies, and our objective and our investment philosophy is built to capture that objective is that we want to harness the growth and value creation event that occurs in small companies as a result of that innovation living there. But we have to do so in a structured way that allows us to manage the risks, but to take advantage of opportunities as they arise. Look, we're active managers. We don't hug an index. Typically, we're about 70 to 85% active versus our benchmark, for instance. We only own the businesses that we like, not those that we don't. And our view is that every stock has to earn the right to be in our portfolio at all times. We look to exploit that under-discovered and under-researched nature of small caps by doing our own primary research. We use our own relationships and connections to understand the opportunity and risks in some of these companies that we look at. We effectively deploy what we call a big stock analysis to all of these little companies out there. We literally tear these things apart, put them all back together, understand the opportunity and the risk, weigh it all up, and then make decisions about what goes in. We're obviously looking for stocks that are exposed to strong themes, searching for those beneficiaries of secular trends. We're looking to identify stocks that have what we call a sustainable competitive advantage, and ideally positioned in verticals that are undergoing a bit of change, because we know that where there's change going on in an industry, that's where market share changes hands. And that's really what we're looking to harness here. The small companies bringing innovation to market in industries that are undergoing change, big market share opportunities. We want to grab we want to grab those opportunities with both hands. I mean, those businesses that have scope for growth are really where we see the heavy lifting done in the portfolio. And that's the ideology that we took into that COVID downturn and really has delivered the performance in this year. In more detail, the performance through COVID, we didn't really outperform on the way down. Yes, we tried to protect capital as best we could, but it all happened so fast. The outperformance really came from the structure of the portfolio and the decisions that we took at the time of going down into COVID and coming back out. And we collected all that value on the way back up. And the portfolio shape, it really had three structures to it. I mean, our first job was to make sure that we were exposed to a core of stocks that would win no matter which way COVID went, if it was a light event or a big event. And those stocks were like telecom companies and data centers. Those are the digital enablers. And we had a good core of those stocks already in the portfolio, and we added more on the way down. But we also focused really hard on what would be the medium-term winners in the scenario. And those were the structural growth companies. Those were target one at the bottom in our view, because we knew those were those market share taking companies. Those are the companies with the competitive advantage that we look for. We just happen to, get them at really good prices. And so that would be the second sort of chunk of capital that we had in our portfolio shape. And the third one, which kind of gives us our view that we're more of an all-weather manager rather than a structural growth or a value type play, is that we had a look around for the best, what we call tactical opportunities that we could find, knowing that there are specific certain sets of circumstances that avail at certain times. And at that point in time, at the bottom, that was looking around for sectors where they were going to be supported by government stimulus. And our best expression of that was retail. And I remember, at the bottom of the market thinking, right, yeah, let's go and get some of these retailers. They were so cheap. And we put up some bids on the 23rd of March and they just got absolutely monstered. Now, looking back on it, that was great, because from then on, the stocks kind of went up. But that gives you an idea of how we like to balance risk-taking versus, protecting capital. That strong core that would win no matter what, and then making small bets in sectors where we know that the conditions are about to change, and take advantage of that. And, that ideology of a strong core, focusing on the medium term with those structural growth stocks, but taking the best tactical opportunities of the moment as well, that's what delivered the outperformance, and that's how we like to play the game. That's our shape, and that's how we roll.
I've in doing a bit of research on the fund, and I was reading some of the articles and literature that you published. I noticed there was a quote that you like companies that are in control of their own destiny. I think for a lot of investors, they look at that and it's probably something that they're striving for as well. Can you give me a feel for what that means for you when you're assessing companies?
Sure. So what we're getting to with that quote, in control of their own destiny, is when you're in small caps and you're looking to harness, the value creation event that people haven't necessarily focused on or priced in, you're looking to have a bunch of factors that are aligned with that goal of growing capital. First one is that a company must have in its underlying portfolio its competitive advantage. What can we do as investors to due diligence that competitive advantage? Because that's really what you're investing in when you're going after a stock that's in control of its own destiny. Because if a management team or a business has that competitive advantage in its back pocket, it's a heck of a lot easier to win no matter what conditions are prevailing. And I'll give you an example. We're in a weak economic environment. Would you rather be in a cyclical company that's exposed to externalities like the strength of the economic cycle that could be weak, or would you like to be invested in a company that will win no matter what those externalities get delivered over a medium period of time? And that's the critical thing. We might not know what tomorrow brings. I mean, very often, I think it was Bill Gates that had this quote. He says, look, the market always overestimates what you can do tomorrow, but it underestimates what you can achieve in 10 years. And so we are looking to position ourselves in that duration gap for some of these competitive advantage companies, and get a hold of those management teams that quite literally have got their hands on those, those control levers, that idea of controlling their own destiny. They need to have something that's competitively advantaged first, and then they need to have the ability to deftly maneuver those control levers to effectively bring that value home for investors. And in small caps, there are heaps of opportunities that fit that bill, but you've got to DD them. You've got to understand the sectors that they play in, and you've got to understand the management team and their objectives and where they are in that journey of value creation along that life cycle from small to big. And if you get it right, your returns are good. And that's how our philosophy and process is all. That's what it's designed to discover and allow us to put those stocks in the portfolio.
Well, uncertainty seems to be one of the words that I think is used most in relation to 2021. Certainly the recent US election is probably a testament to that. How are you and the team positioning the fund for the next 12 months? What are some of the structural trends, without giving away too much, that you're looking at?
Yeah, well, as you'd expect me to say with someone that wants to repeatedly, apply a philosophy and a process and let the returns flow from that, is that shape that we have of a core of stocks that we don't think will be impacted by whatever happens with those big externalities that we can't call. And then you've got this view that if we have the most competitively advantaged companies in markets that, yeah, they might be buffeted in the short run by these big externalities that we can't call, but they've got something in their portfolio that in the medium term, coming back to that Bill Gates quote, are going to deliver. And then you have another bucket of capital that's focused on taking the best tactical opportunities that you can see at any given moment in time, to sort of harvest, if you will, the best of the moment. That makes you kind of an all-weather type manager. That's the shape that the portfolio's got today. It's the shape that it had going into COVID, going through COVID, and it paid dividends then. And we think that's the best shape going forward. But there are some, as you posed the question, some structural themes that we're lining the portfolio up with today. I'll go through a couple. I mean, the first one is one that's been quite long standing in our portfolio, and we think it's as resonant today as an opportunity as it was when we first put the fund together, and that's cloud technologies. If we start there, the cloud technologies, they have changed the unit economics of technology with the deployment of cloud technologies out there. And as you will see as I go on, that change is most profound in the small cap universe that we look at today, because what it does is it alters the relative competitiveness of small caps relative to their, big market share owning big cap companies out there. So, in the past, technology capability was a competitive weapon that was only available to large companies because of its heavy upfront investment and high cost to maintain. In the old days, you effectively needed the scale of a big company to make the economics of technology work for you. Cloud has completely changed the game. It has literally handed the keys to the big company IT department to the small guy. And remember, we believe innovation lives in Australia in small caps. So you've got this beautiful combination of innovation and now what used to be a technology disadvantage removed. And actually it's a technology advantage now, because many of these big companies come with complexity. And cloud tools are, today you only pay for what you want when you want to use it. And it allows you to check, test, fail ideas and learn in a way that, you could never do before. And in a timeline that these big companies that are complex just can't react to. So what it means is it gives these small companies that we're investing in a market share wedge opportunity that they've never had before. We're seeing that. And the experience profile we've got on our team here, we're quite well positioned to capture value against that theme. So that's one that we've been playing. It's been very successful for the fund so far. And, this is a theme, it's a multi-decade theme. So we're quite happy to keep owning stocks that are plays on that dynamic. And right at the other side of the portfolio, some of those tactical themes that we've been playing, they've made good money for the fund. I mentioned retail at the opening part of this video, but an area where we're investing today is more short term. And of course, that's around vaccine deployment, economic reopening. And we know Australia's position is a little bit different than the rest of the world because, we've handled COVID well here versus the rest of the world. They're going to have to live with it. Whereas, what that means is, we used to spend billions of dollars traveling internationally. I think it was something like $60 billion last year we spent traveling internationally. That money isn't going outside the shores of Australia. That's staying in our economy. So we're placing investments into areas of the economy that will benefit from that incremental spend against a backdrop of already very strong domestic government support and low rates here. So we've invested in companies in domestic tourism, in housing, on the benefit, the idea that house prices will rise, all those kind of characteristics we're trying to deploy to reap the benefit from in the portfolio. So it gives you a nice balance and flavor of the themes that we are looking to exploit in the portfolio today.
Excellent. Gary, thank you. That's been very insightful. And as I mentioned at the very start, after 1 year, the fund is going extremely well. So congratulations. And good luck for the next 12 months and the ensuing many more 12 months after that.
Look, many thanks. Great to chat. And we'll certainly take that luck and put it in the back pocket and take it with us.